Hey everybody, this is Bob from Trade Genius. I got my good friend Phil with me today. So something happened yesterday that might be the credit event that causes a sharp correction in the market. And we have data to show that that could be possibly the case last time it happened. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, out of the blue, Fitch and I guess another rating agency decided to downgrade U.S. credit from AAA to AA, which is kind of out of the blue. I mean, for you and I, it was, obvious, but out of the blue for the sheep out there, can you kind of give us some perspective on, first of all, what happened, what it means, and what has happened in the past?
Yeah, so we'll slide over to this slide here. The last time this happened, Standard & Poor's downgraded America's credit rating, and that was actually during the debt ceiling drama of 2011. So, debt ceiling dramas are a reoccurring theme, but essentially it kicked off a move down where ultimately for the month of August, the S&P 500 was down 17% and the Russell was down 24%. So, the headlines definitely drive a narrative for these markets. Now, when people hear about the ratings downgrade, you get a lot of different takes on that. And, it's like, oh, the bond market's going to implode. It's over. We're going to crash. Well, in reality, the treasury auctions and everything else just keep on trucking, right? But what it does, though, is it does affect AAA rating for things like collateral. So they will use the treasuries, the T-bills and things like that for collateral, right, at the brokerages. And that's a lot of what's been fueling this move up. And T-bills get purchased, turned around, used as collateral. Well, if it's not AAA rated anymore, then sometimes they can't use it for collateral. Now, in this situation, in 2011, we had the S&P 500 actually do the downgrade, and then the Fitch didn't technically do a downgrade, but what they did do is they gave it a negative outlook. This time around, Fitch has done the downgrade, and Standard & Poor's hasn't really said anything yet. If it's one credit agency out of the three, then we have what's called a split downgrade, meaning that one's showing AA plus and the other two are showing AAA. So it's not super dire. Where it gets a little more interesting is if S&P Standard & Poor's comes in and says we're downgrading to AA plus. Now that has a little bit more teeth and you're going to see more de-risking. Here's the weird thing about it all, though. If you think, oh, the treasury market's toast, bonds are toast, and yields are going to just start skyrocketing. I mean, the yields are climbing, don't get me wrong. And I think we're going to continue to see the long end now rise, which is typically what we see and what we've been preaching about, where we're ultimately going to see this yield curve inversion bottom and start climbing back up. And really what we're going to start watching now is the 3-month 10-year yield yield curve, because typically once that crosses the zero line, gets back to par, you can almost just mark that as the start of the recession every single time. Very high hit rate for that. So that's the next thing that we need to look at. And we're going to get into the yield curves in another video this week. But back to the point, when this happens, okay, and you have rule-based funds, some rule-based funds are not going to be able to mess around with anything that's not AAA rated. So there is going to be some of that. So there is less demand from bonds from those participants. But by and large, what ends up happening is that when the market starts to get shaky, when VIX starts to pop, they're still going to go to the treasuries as a flight of safety trade. Now you're going to think, well, why would they do that? It just got downgraded. Because if it's going to create market instability, your bond market is still going to be the safety trade, even though it's downgraded a notch. It's really immaterial because A, we're the world reserve currency. We don't have any foreign denominated debt, and we print our own money, which is the world reserve currency. So, it's not really going to do much to us in terms of functionality of our treasury market. But the weird thing is that when this happens is that funds will have to change changed their risk weighting profile. So there's a lot of rules as far as that goes. So now what they've done is they have treasuries, those become more risky. And so now they have to meet certain risk requirements. So now they're overweight on their risk. They have to then de-risk equities. Okay, so it's actually bearish for the market in that regard, because as things get more unstable, they will buy more treasuries. Yes, even though they're downgraded, that is the safety trade. So you're going to pile into more treasuries. That's going to make them more overweight on their risk, and it's going to force them to de-risk equities or stocks or whatever risk on assets that they have. That's why the market goes down. It's not so much a function of the bond market is toast and it's going to implode. It's just that the rule-based funds and things like that are forced to de-risk these assets. So that's why we're probably going to see a drop. That's the nuts and bolts behind it under the hood. And if you look at this chart, why we went down from August down into September, I would not be surprised, guys, if we see something very, very similar here. And then you do end up getting kind of a sympathy bounce. But make no mistake, with today's treasury issuance clarified, the amount of coupons that are being issued, which is different than what we've been seeing, right? We saw a lot of T-bill issuance. So coupons and bonds are going to be the longer back end, which they have to do because doing the short end of the curve on the T-bills is unsustainable. They can't afford to do that. There's going to be too much interest due. So they can't do that anymore. They have to now focus on the back end. Well, I think they were somewhere in the vicinity of $370+ billion of the longer dated issuance going into the Q4 TGA build. And that's going to be a problem for the markets because that gives us the same environment that we were in going from Q1 into Q2 2022. And if you remember, Q2 2022 was really ugly for the markets. And that's what we're in for going into the end of the year. So like Bob and I have been telling you guys, the back half of this year is going to be bearish. And I think that what we saw today out of the Treasury and clarifying what the debt issuance, or the type of debt issuance that was going to be, is confirming that. So I think that's it going forward. That's kind of the explainer here, Bob, on what that downgrade really means. It does mean risk off, I think. And definitely, we're also doing it seasonally, right? And interestingly enough, 2011, August, same timing, right, for this. But seasonally, August is already a bad month for seasonality. VIX gets very bullish in August. So I think you have multiple things coming together here. And we're like hundreds of points over fair value, which I think even though we've had a deviation from the net liquidity model a little bit because of this concentration in T-bill issuance, I think we're going to snap back down to that reality. And I think last week we had a risk off on the weekly, which is really the one that you want to pay attention to. The dailies are more short term, and sometimes there can be a deviation from those as we saw here, but the weekly you have to really pay attention to because that was the one that has the big teeth and matters the most.
Yeah, and I think you're going to see probably a steepening of the yield curve, which means that
correct.
People may run the safety in the 2-year, but they're going to be blowing out the 10, the 20, and the 30-year.
Yes,
and that's why we've been in TBT and why we think the 10-year is going to run out to 5% plus. It's going to be worst of all worlds. But the key here is that if we get back inside what they call the FOMC range, remember that bearish engulfing pattern we had last Wednesday? We had inside days all the way from last Wednesday on. It gapped it up Thursday. Everybody said, oh, they ignored the Fed. But that's not how we saw it. We saw it inside, inside, inside. Yesterday we dropped a little bit. And today we gapped down and we went underneath that range. So if we stay under 451.55 on SPY, then I think we're going to see continued weakness here in the market. And Phil, people don't realize August is kind of a sneaky bearish month. It could be benign, and then you get these baseball bats to the side of the head in August. Everybody always looks at September and October, but you got low volume and then you get events, and we just got an event. So it's time to pay attention. The Jenga tower is as high as it can be. It's not going to take much to push it over, and it's time to be very, very careful. Today's total risk off. Energy down, market down. Not good news. So, hey, Phil, do you want to show the RRP chart real quick?
Yeah, I do. So, guys, this is really what's been driving the market, and RRP is the reverse repo, and that's in blue. I inverted it because it has an inverse relationship with the market. If the balance in the RRP draws down, that's bullish for the market. If it builds back up, that's bearish for the market. Think of it as taking supply away or adding supply back to the market. So it's an inverse relationship. So I inverted it on this chart to kind of match the movement of the stock market, which is in orange there. So you can see that the aggressive drawdown in RRP matches the rise in the SPX. And so now what we're looking for is, now that T-bill issuance we were talking about is done, that this starts to roll over, and then the net liquidity model starts to act as gravity, and this thing comes back down. So that's what we're watching for here, guys, is this thing to roll over. And I did see the early numbers today. It is dropping back down. We need to see consecutive days of that. And if we do see that, then I think you're going to see a lot of downward pressure on these markets. Granted, the treasury account's going to be drawing down, which is actually technically bullish for the markets. However, on net, with the balance sheet from the Fed being reduced, we should continue to see net liquidity go lower. And this has a lot of catching down to do, because I think we're over fair value by like 800 points or something like that. So we'll meet somewhere in the middle, probably, where price comes down and then fair value comes up a little bit, and we'll meet in the middle. You have a lot of downside air under us, especially with this weak month of August, and it usually carries through into September as well. But then once we're through that, you have to start looking for a bounce as we go up into Q4. Now, when we start going into Q4, that bond issuance becomes a huge deal, and I think you have to look for a fade back down. So we'll probably have some decent two-way swing trading here, but I think we got to be bracing for a not so great end to the year due to those situations going on.
Yeah, and thanks for that, Phil. And guys, if you want to check out our service, go to tradelikeagenius.com. We think we have a pretty good pulse on this thing. And, I think we're setting ourselves up as really good trades here going forward. Volatility is our friend. But if you want to keep listening to us the rest of the week, hit subscribe, notification. We have some pretty cool stuff between now and Saturday to teach you and to show you. And remember, when you have these kind of market dislocations, opportunities present themselves, and it's going to be an opportunity to make a lot of money. So thanks for listening. Have a great day. Talk to you later.